I got the recorder going. Michael is the Uber LMT guy out there. Loves his Lockheed Martin. Okay, let's take a look here at a Lockheed chart. And, you know, talk about falling off a cliff. I mean, these defense stocks have just gotten blasted. Blasted. No pun intended there. Did not mean to, you know, come across like that. You know, if I'm looking for something technical, you know, you can always try and find something technical, right? It's coming down to an area here, no doubt, where back in, man, this is almost 2 years ago, so February of 2017, there was some resistance here, which then this has not seen the light of day since. First time really it's coming down to that resistance. Okay, that's number one. Number two, there's a ton of volume back there. So when it was trading down here, okay, when it was trading down here, there was a good amount of volume. Okay, couple indicators that we look for. Now I'm just looking off to the side here, what's going on with our defense stocks and this, that, and the other. You know, would I want to get in it here? Yeah, I think, you know, for the longer haul, this is probably a place that you want to get in. Lockheed Martin for the longer haul. And I'm talking about longer haul for, you know, more than the week or two that we would typically look at. Now, is there some risk, or is this why volatility is so elevated? Although it's down, implied vol is actually down 16% today. Okay, it's still pretty high, though. I don't think Thinkorswim has really adjusted yet, because this is still showing us up pretty much where it was prior to a drop today, but we can look at it. But we still know it's trading pretty high. Okay, so again, the reason that this is so high right now, besides the overall market volatility being high, is, Rob, you said it, pull back from there. I don't know if there's any sort of budgetary constraints with the government possibly shutting down, or with this $5 billion number to keep the government running, if any of that is allocated towards defense stocks. So maybe that is why. But if you're bullish here, and so here's that area that we were just looking at back on the TOS chart, right around 253, 255, that area right there. Okay. The low today was 256, so it almost hit that, and it bounced. You know, that could have been because it hit that area down here. But let's say you're bullish in that area, but vol is extremely high. Okay. What you then do in terms of what sort of option play you'd want to do really depends on your time frame. Do you think that Lockheed is going to turn around and really rally, or do you think it's just kind of going to stop going down, right? Because we would look at two different strategies. Okay, if you think it's kind of just stopped going down, we'd probably more likely look at either just selling a put spread or selling an iron condor. If you think that we've hit a point where it's going to turn around and really rally over the next, whatever, 4 weeks, whatever it is, you want to look at some upside play. But with Vega, or with volatility, implied vol where it is right now, you certainly don't want to get long vol. So that's the perfect time for, the type of setup like a broken wing call butterfly, where you can get long delta but not have long volatility. So, Michael, give me your time frame. Two to 3 weeks. Okay. Let's go out. How about if we go out to just regular January expiration? Okay, which is the 18th. But in fact, we have more flexibility. Markets are wide, but we have better flexibility going with the weekly before that because strikes are only $2.50 wide. Okay, but let's say you wanted to sell kind of an at the money or just slightly out of the money put spread. Okay, because you think that this area that we saw there, 255-ish, really is kind of the bottom. Maybe you just sell a 257.5, 255 put spread for $1.05, something like that. Or if you think that it has stopped going down or come to some really significant support, but you're not really so sure about it being so bullish in the near term, then that would be a really good time to do an iron condor that has a bit of a bullish bias, because you're willing to accept the fact that it's not going down further, but has maybe a little room to the upside. Okay, so maybe then you look at something like kind of this at the money or just slightly out of the money put spread. Okay, but then a further out of the money call spread. Okay, so here, super wide market. So kind of hard to tell what this thing would trade at. But if you could sell this for even, let's say, $2.50, okay, then you're looking at 255 on the downside, which puts you right at that support area we were looking at. And it puts you 277.50 on the upside, which really is right about what the expected move is between now and that January 11th expiration. So that's a way to play this and collect more premium. No, that's not true, Michael. Not here. Not if you sell this for 250. If you sell this for 250, it's 1-to-1. Okay, let's look at this same scenario though going out 1 week. Oh, I got you. Okay, but remember though, the reward to risk that you're looking at though is not going to coincide with our typical benchmarks, because we're not looking at selling a put spread that's down at the expected move, right? We're looking at something that is so much closer to the money because we think that we're drawing a line in the sand. But let's look at this. Let's go 1 week further and go down to the 255, 250. Hang on 1 second, guys. Hello? Hello?
Hi, I'm from Lockheed. I got your car here.
Okay. You want to just take the other one and leave the keys in that car?
Okay.
You'll leave the keys in the car. Thank you.
Okay.
Bye-bye.
Thank you.
All right, sorry about that, guys. So you could sell this kind of close to at the money put spread, and then go out and sell, maybe the 280, 285. Oops, don't want that. Okay, so even that, now you're getting a very tight market, right? Before you had this $5 wide market because we were using weekly options out there that didn't have a lot of open interest yet, no volume. Now you're getting a tighter market, and this is right in the realm. Okay, So let's say you could do this for 250. I don't know that you could, but let's say you could do this for 250. Now you brought the downside break even down even lower, below that area of support that we thought. So 252.5. And now my upside is 282.5, which still actually is greater than, just outside of the upside range of what the market is expecting. I actually like this a lot. Now, what can go wrong with this? Obviously, if stock moves, huge one way or the other, we're playing for a more of a range-bound trade, even though this is definitely more on the bullish side. Okay. And if vol increases, this could go wrong. I personally don't like trading iron condors that far out in time because you're kind of handcuffed. But that being said, this is one to, if you're, again, in the mindset that maybe Lockheed is not going to recover so much, but that it's kind of stopped going down, not bad. Now what I would do is maybe shorten this up, and let's look at, not next week, but January 4th. Okay? So basically 2 weeks out. And let's see if there's something there that might make sense. Okay, now, here's one for $2. So again, you got to throw that reward to risk kind of out the window now, because we're not monitoring, we're not measuring based off of what our expected move really is. Okay, but here's one only going out 2 weeks, where if you could get $2, I don't know that you can, but let's say for argument's sake you could get $2 on this. Now you've got a 255.5 downside break even, which is really right at that support level that we talked about. And you've got a 282 upside. That 282, maybe that's even too far, because the expected move for 2 weeks from now is about $15, $16. Puts you at around 277. But for a $2 credit, this might be worth it. Well, Ken, that's exactly why I went out a little bit further in the upside strikes, to give myself even more room. Also remember one thing, okay, the way options work. Okay, also remember this. If the market recovers, or if Lockheed recovers, okay, or just goes on a little run to the upside, what's going to happen to volatility? Just natural course of how options work. What's going to happen? Exactly, volatility is going to come down. If volatility comes down, that is a positive for this position. Right, because we're selling the position, Chris. So if we're selling premium and volatility comes down, that does two things. A, the expected move then shrinks as well. So now we have even more protection on either side, because the expected move has now contracted. And B, as volatility comes down, the amount of premium that is in this is going to shrink as well. Okay, now, What are your risks? Okay. We have 255 half on the downside. Well, we've identified that as an area where there is some support. But if for someone, and Michael, maybe this is you, for someone that says, you know what, I really like where Lockheed is right now, then great, you're okay, you're comfortable with the risk that if Lockheed goes down, that maybe you would, want to initiate a long position there anyway. I actually like this. Probably wouldn't do it for less than $2, but I think if you could get $2, I think that's pretty good. You could do that too, Ken. Absolutely. So here's where kind of trading nuance, trading acumen plays into it. Okay? If you're comfortable that Lockheed has stabilized, okay, then you could lean or leg into this iron condor by selling the put spread first. And then if the stock does start to rally, start to go up a little bit, the benefit you have from that is if you still want to sell the upside call spread to make it an iron condor, one of two things. You could sell this same call spread then that we have on the board, the 280, 285, probably for more than what it's showing right now. Or maybe you're able to even adjust the strikes higher then and get the same amount of premium. Yep, exactly, Ken. Does everybody understand that about legging? So there's lots of options, no pun intended, that you can do with this. Again, this is all with the premise that you're neutral to slightly bullish in Lockheed and that you want to sell some premium. Okay, Michael, does that help? And thanks for bringing up the question in the discussion. I like this a lot. I like this a lot. And from here, guys, you're not locked into these strikes. You can always, play around a little bit. Maybe, if you want to lower the strikes on the downside a little bit to give yourself a little bit more room and take, maybe another nickel or a dime less, you do that. Lower the strikes on the upside, however you want to do it. But I think this is a pretty good setup here to take advantage of exactly what Michael was looking to take advantage of. Have to, right? You know what? If you, for anybody that was watching my TD spot yesterday when I was over there with Kevin Hanks, we talk about this. He and I talk about this all the time. Every position you take starts with an educated assumption. Once you've formed that educated assumption, then you try and back into it and find what the best opportunity is. That is how trading works. All right? Everybody understand? All right, Michael, thank you for bringing that up. Roger, you can do that too. I mean, you certainly have all sorts of options. Remember though, sometimes the more intricate you try and get, the more difficult it becomes to manage. But there's no reason why you couldn't do that. Rob, yes, maybe you missed the beginning of the discussion. Yes, the assumption here was that Lockheed is maybe not due for a big rally, or maybe it is, but that it's found an area of big support and just not going down much further. So that was the assumption to start the conversation with. Okay? Exactly. Very, very well put. Very well put. Ivy's definitely not low. It is, but it's still at the very, at the higher 25%, or 75% or higher area. No question about that. Paul, we were looking for about $2. I think at $2, this is probably a pretty decent opportunity. All right, guys, let me get this video posted up in the room, and I'll be back.